Did you know that nearly 60% of Americans don't have enough savings to cover a $1,000 emergency? Even more shocking, a study by Credit Suisse found that over 40% of the world's population has less than $10,000 in wealth. For many, financial freedom feels like an impossible dream. But what if you could change that? What if you could double your money safely without taking wild risks or gambling with your future? In this video, we're diving into strategies that can actually help you grow your wealth, without the typical dangers that come with most get-rich-quick schemes. You'll learn how to build a wealth mindset, leverage passive income streams, and make smart, low-risk investments that can boost your money over time. Stick around as we explore real, actionable steps to doubling your money while staying safe. It's not about luck, it's about strategy. Let's get started. Chapter 1. The Wealthy Mindset Shift. Think like a millionaire. If you want to double your money, it all starts with your mindset. Wealthy people don't just work for money, they think about it differently. They focus on creating value and opportunities, rather than just earning a paycheck. Jim Rohn, a well-known motivational speaker, once said, "Success is not to be pursued, it is to be attracted by the person you become." Your beliefs about money shape your financial success. Start by understanding that wealth is a journey, not a quick fix. According to a study by the National Bureau of Economic Research, successful investors often have a long-term view, which helps them ride out market volatility. In fact, those who think about money over a span of 10 to 20 years are far more likely to succeed. Wealthy individuals also avoid the trap of instant gratification. Instead of spending, they invest. Research shows that 60% of millionaires have at least one income-generating asset. This could be anything from rental property to stocks that pay dividends. One simple shift in thinking can make all the difference. Think about what your money can do for you, not just what it can buy. When you put your money into assets that appreciate, it will begin working harder for you. This could mean investing in things like businesses, real estate, or index funds, rather than just spending on depreciating items. And don't forget, a millionaire's mindset includes the ability to take calculated risks. According to the Global Wealth Report, 48% of millionaires invest in stocks or bonds. The key is to approach it with a strategy, not blind luck. Chapter 2. The Power of Passive Income. Earning while you sleep. Imagine waking up and checking your bank account to see you've earned money overnight. That's the power of passive income. It's a game changer in how you build wealth. And no, it's not just a pipe dream. It's achievable with the right strategy. In fact, 30% of millionaires generate a significant portion of their income passively, according to a study by the Spectrum Group. So, what are the best ways to tap into passive income? Real estate is one of the most reliable sources. For example, rental properties can provide a steady cash flow. According to Forbes, real estate has outperformed the stock market by nearly 2 to 1 over the last 20 years. If you're not into property, there are other passive income options. Peer-to-peer lending platforms, such as Lending Club, allow you to lend money and earn interest on your loans. The average return for investors in these platforms is around 4–6% annually. Another lucrative source is creating digital assets. Think about writing an ebook, starting a blog, or creating online courses. The beauty of digital assets is that once they're created, they can generate income for years. In fact, many creators report earning thousands of dollars each month with just a handful of products. Dividend stocks are also a great way to make your money work while you sleep. The average dividend yield in the US stock market is around 2.5%. While this might not seem high, reinvesting those dividends can result in significant long-term gains, thanks to the magic of compound interest. Chapter 3. Safe yet strategic. Navigating high-yield investments. Doubling your money isn't about finding a shortcut, it's about making smart, strategic investments. High-yield investments can be safe, but they need to be approached carefully. In fact, according to a 2023 survey by Bankrate, 29% of investors are interested in high-yield savings accounts, while 11% prefer to invest in dividend-paying stocks. One of the safest high-yield investments is bonds. But not just any bonds. Consider municipal bonds or investment-grade corporate bonds. These tend to be low risk but still offer returns that can outpace traditional savings accounts. For example, the average return on a municipal bond is around 3%, compared to less than 1% on standard savings accounts. Real estate investment trusts, REITs, are another great option. REITs allow you to invest in real estate without actually owning property. These trusts pay out most of their income as dividends, with an average yield of around 4–7%. REITs can offer good returns with relatively low risk compared to directly buying real estate. Don't overlook the power of certificate of deposits, CDs. While they won't make you rich overnight, they're a safe and guaranteed way to grow your money. The current national average interest rate on a 5-year CD is around 3%, but some banks offer higher rates, depending on the term and amount. Lastly, consider safe but slightly higher risk alternatives like peer-to-peer lending platforms or even stable coins in the cryptocurrency space. Stablecoins, pegged to stable assets like the US dollar, can offer returns upwards of 8% in certain platforms. Just make sure you thoroughly research and assess the risks before diving in. The secret to success in high-yield investments is balancing risk and return. By diversifying your portfolio with a mix of safe investments, you'll be able to mitigate risk while still striving for high returns. Don't forget to subscribe to get more insights like these, and hit the notification bell so you never miss a strategy for your financial freedom. Chapter 4: Money Multipliers. Leveraging your assets without the gamble. One of the best ways to double your money is by leveraging your assets. But don't confuse leverage with gambling. Using what you already own, whether it's property, a business, or even your skills, can help your money grow exponentially. Warren Buffett famously said, "Risk comes from not knowing what you're doing." When you understand your assets and how to use them, you're reducing risk and maximizing potential. Let's talk about real estate again. If you own property, you can leverage that asset by taking out a loan to purchase more property. This is a tactic many real estate moguls use. According to Investopedia, real estate investments have an average annual return of 8–12%, depending on the market. With the right strategy, you can multiply your initial investment many times over. But you don't have to be a real estate expert to leverage assets. Businesses, for instance, can be another great wealth multiplier. Many entrepreneurs build wealth by scaling their business. In fact, small business owners in the US can see returns of up to 30% annually, compared to the stock market's average return of 7–8%. Another interesting multiplier comes from leveraging your skills. Think about offering a service or creating a product that requires minimal input once it's set up. For example, software development, coaching, or even digital marketing services can turn your time into a high-paying asset. In a 2022 survey, 39% of entrepreneurs stated that their businesses were profitable because they scaled with little overhead. The key is to take your current resources and find ways to make them work harder for you. By leveraging assets effectively, you can accelerate the process of doubling your money while keeping risks in check. Chapter 5: The 30% Rule. A radical approach to smart saving. When most people think about saving money, they focus on cutting expenses. But what if we took a different approach and focused on maximizing the percentage of your income that goes into investments? The 30% rule is a strategy that challenges the idea of typical saving and investing. Instead of saving what's left after expenses, this method suggests saving and investing 30% of your income right off the bat. This strategy isn't new. It's actually rooted in the teachings of financial experts like Dave Ramsey, who has helped thousands of people build wealth using the concept of allocating a specific percentage towards savings and investment. If you're earning $50,000 a year, committing 30% means putting $15,000 directly toward building your wealth. The 30% rule works because it forces you to prioritize your future. It's not about squeezing every penny. Rather, it's about rethinking how you use your money. The beauty of this method is that it automatically boosts your investment habits. And as a result, you're more likely to invest in assets that provide long-term growth. A study by the Employee Benefit Research Institute found that only 55% of Americans are saving for retirement, with many people saving less than 10% of their income. The 30% rule pushes you to increase that amount, giving you a higher chance of financial freedom. Over time, This can mean doubling your savings faster than most traditional savings plans. Additionally, the 30% rule encourages lifestyle adjustments that make a big difference. It often means cutting unnecessary expenses and focusing on value-based spending. This gives you more capital to invest in growing your wealth rather than on fleeting luxuries. If you're finding this useful, don't forget to subscribe and hit the bell to stay updated on more strategies to boost your financial journey. Chapter 6: Safeguarding Your Wealth. How to protect gains on your journey to double. Growing your wealth is important, but safeguarding it is just as crucial. When you've worked hard to double your money, you don't want to risk losing it all because of poor decision-making or a sudden market downturn. Protecting your wealth is all about creating a strategy to preserve what you've earned while continuing to grow. One of the simplest ways to protect your wealth is through diversification. According to a 2021 report from Vanguard, a diversified portfolio has historically shown less volatility and higher returns. Instead of putting all your money into one type of asset, spread it across stocks, bonds, real estate, and alternative investments. This approach minimizes risk while giving you opportunities to grow your wealth in different areas. A strong emergency fund is another critical part of wealth protection. Financial advisors recommend having 3-6 months' worth of expenses set aside in case of unforeseen events, like job loss or medical emergencies. This safety net ensures that your investments remain untouched during rough patches, allowing you to stay the course. Insurance also plays a huge role in safeguarding wealth. Whether it's life insurance, property insurance, or liability insurance, having the right coverage can protect your assets from unexpected losses. In fact, a study by the Insurance Information Institute found that 44% of homeowners don't have enough coverage to protect their homes fully in the event of a disaster. Moreover, asset protection strategies, such as setting up a trust or using LLCs to separate personal and business assets, can be effective tools to protect your wealth from creditors, lawsuits, or unexpected events. The key here is planning ahead and being proactive. It's not enough to just grow your money, you need to make sure it's secure for the long term. Lastly, consider using hedging strategies, like purchasing options or investing in precious metals like gold, to protect against inflation or market downturns. According to the World Gold Council, gold has been a reliable hedge against inflation for centuries, making it a solid addition to a wealth protection strategy. In the end, safeguarding your wealth is about creating a balanced approach. You don't just want to focus on growth, you also need a plan to ensure that your gains are protected as you journey toward financial freedom. By combining diversification, emergency funds, insurance, and legal protections, you'll be in a much better position to preserve and build your wealth safely. By strategically leveraging assets, committing to the 30% rule, and implementing wealth protection strategies, you can safely double your money and work toward achieving financial freedom. The road may take time, but with patience and the right approach, your financial future can be brighter than you ever imagined. Don't forget to subscribe, and hit the notification bell for more strategies to help you on your financial journey.